Welcome to StokTok's deep dive into Franco-Nevada Corp. Franco-Nevada is a precious metals streaming and royalty company that finances mining operations in exchange for the right to purchase gold, silver, and other commodities at fixed prices. The company operates across multiple jurisdictions and holds interests in some of the world's largest and most productive gold mines. This business model creates a lower volatility revenue stream compared to traditional mining companies. Over the past 52 weeks, the stock has traded between $153 and $286, establishing a meaningful range for context. As of Friday, May 8th, the stock is trading at $232, positioning it in the lower half of that range. Let us work through the fundamentals, scene by scene, starting with a quick business overview. Franco-Nevada generates revenue through two primary channels: streaming agreements and royalties on precious metal production. In a streaming arrangement, the company advances capital to mining operations and receives the right to purchase a percentage of their gold or silver output at a fixed or discounted price, locking in margins across commodity cycles. Royalties work similarly but require no upfront capital. The company simply receives a percentage of revenues or production from operating mines. This model creates a durable moat. Once a streaming or royalty contract is signed, it typically runs for decades, creating predictable, inflation-hedged cash flows. The competitive advantage lies in Franco-Nevada's capital, its relationships with Tier 1 mining operators, and its ability to negotiate favorable terms. The StokTok score for Franco-Nevada is 52 out of 100, with a hold rating. Breaking this down, Valuation receives 10 out of 20 points, Financial Health scores 15 out of 20, Profitability rates 13 out of 20, Growth earns 12 out of 20, and Smart Money sentiment is notably weak at just 2 out of 20. Now, valuation. The question every investor has to answer: are you paying the right price? Franco-Nevada trades at 39.4 times trailing 12-month earnings, or a forward PE multiple of 25.9. These are premium valuations. For context, the broader market typically trades around 16 to 18 times earnings, while the precious metals and mining sector has historically traded between 12 and 20 times, depending on commodity cycle phase and sentiment. The EBITDA multiple sits at 25.1 times, which similarly reflects a significant valuation premium. The price-to-sales ratio of 23.8 is extraordinarily high, suggesting the market is pricing in substantial operational leverage and margin expansion. The PEG ratio, which divides the PE by expected earnings growth, is not applicable here due to the way consensus growth rates are structured. The DCF fair value assessment shows 0% margin of safety, meaning our intrinsic value model suggests the stock is trading at a premium to fundamental value rather than a discount. This is a critical warning signal. Wall Street analysts, by contrast, maintain a more bullish stance. 9 analysts cover Franco-Nevada with a consensus mean price target of $303, representing approximately 31% upside from current levels. The high target on the street sits at $354, implying 53% upside, while the low target is $273, only 18% above current prices. Weighing both signals, our DCF premium and the analyst consensus, a reasonable fair value range, in our view, sits between $273 and $305. This accounts for both the current premium valuations and the street's optimism about near-term catalysts. Market sentiment around Franco-Nevada leans bullish. The company has demonstrated operational confidence and transparency through recent releases of its asset handbook and sustainability report, while the broader junior mining sector shows momentum with well-capitalized explorers advancing toward major milestones. These developments suggest positive sentiment around the company's portfolio and the gold sector's near-term catalysts. However, valuation stretched relative to intrinsic value remains a headwind. Investors should be aware that they are pricing in meaningful operational execution and favorable commodity market conditions. Moving to financial strength, how solid is the foundation? Franco-Nevada scores a 7.0 on the Piotroski F-score, which is a 9-point financial health checklist that examines profitability, operating efficiency, and balance sheet quality. A score of 7 indicates solid underlying financial health, though not exceptional. The Altman Z score, which measures bankruptcy risk across multiple financial dimensions, stands at 43.71, far above the safe threshold of 3.0. This places Franco-Nevada in the extremely low bankruptcy risk category. The company's balance sheet is fortress-like. Examining the capital structure in detail, Franco-Nevada carries zero debt relative to equity, meaning it operates entirely on an equity-financed basis with no leverage. This is conservative by design and appropriate for a company in the precious metals space where commodity cycles create volatility. The current ratio, which measures short-term liquidity by dividing current assets by current liabilities, stands at 8.3. This exceptional level means the company can cover its short-term obligations more than 8 times over, indicating no liquidity stress whatsoever. Interest coverage, the ratio of earnings to interest expense, registers at an astronomical 4,064 times. This metric is essentially irrelevant for Franco-Nevada because the company carries so little debt that interest expense is negligible. In summary, Franco-Nevada's balance sheet is conservatively structured, highly liquid, and poses virtually zero financial distress risk. This is a significant strength that provides downside protection in a downturn. Next up, profitability. Is this business actually making money efficiently? Return on invested capital, or return on invested capital, measures how effectively the company deploys shareholder capital to generate profits. Franco-Nevada's return on invested capital stands at 16.1%, which is a healthy level indicating that for every dollar of capital invested, the business generates approximately 16 cents of annual operating profit. This is above the cost of capital and suggests the streaming and royalty model creates economic value. Gross margin, the percentage of revenue remaining after direct production costs, reaches 73.9%. This is exceptionally high, reflecting the advantaged nature of the streaming model. Once streaming contracts are established, Franco-Nevada does not bear the full operational burden of running mines. Instead, it collects revenues from commodity sales at predetermined prices with minimal variable costs. Operating margin, which measures earnings before interest and taxes as a percentage of revenue, reaches 71.6%. This exceptional profitability indicates that Franco-Nevada's business model is highly scalable and that corporate overhead is well controlled relative to the revenue base. Net margin, the bottom line, reaches an impressive 60.9%. This means that nearly 61 cents of every dollar in revenue flows to net income. This is substantially higher than typical mining companies and underscores the efficiency of the streaming business model. Free cash flow margin, however, tells a different story. It registers at negative 38.6%, meaning the company is generating less free cash flow than its reported net income. This divergence typically reflects significant capital expenditures or working capital outflows required to maintain and expand the streaming portfolio, or potentially timing differences in cash collection. Investors should monitor whether management is deploying capital productively or whether cash outflows are structural. In summary, Franco-Nevada is highly profitable on an accounting basis, with exceptional margins throughout the income statement, but free cash flow generation lags reported earnings. On to growth. Is this business expanding, and at what rate? Revenue growth over the trailing 3 years stands at 12.1% annualized, indicating steady but moderate expansion. Over the longer 5-year horizon, revenue growth slowed to 8.8% annualized. This deceleration suggests that growth is maturing. The company is no longer in hypergrowth mode, but rather expanding at a pace modestly above GDP plus inflation levels. This is not necessarily negative. It reflects a company with an increasingly large installed base of streaming and royalty contracts becoming harder to grow at double-digit rates. Book value growth, which measures the expansion of shareholder equity on a per-share basis, grew 6.3% over 3 years. This is lower than revenue growth, suggesting that earnings growth has outpaced book value accumulation, a sign of improving profitability per dollar of equity. The dividend yield stands at 0.7%, a minimal payout to shareholders. Franco-Nevada evidently prioritizes capital retention and reinvestment into the streaming portfolio over shareholder distributions. For investors seeking income, this is not a yield story. For growth-oriented investors, the question is whether that retained capital is being deployed at adequate returns. Given the exceptional profitability metrics we reviewed, the reinvestment appears productive. In summary, Franco-Nevada is a modest growth business with decelerating revenue expansion, but improving profitability and capital returns. Investors should expect low to mid single-digit annual growth rates going forward, not the expansive growth of a junior miner or an exploration stage company. Now let us talk smart money, what institutional capital is actually doing with this name. 7 top-tier investment gurus currently hold Franco-Nevada according to our database. However, this backing is not as strong as the raw number suggests because the sentiment from the broader hedge fund and institutional community is notably weak. Only 3.4% of all 13F institutional filers, those managers required to disclose their holdings quarterly to the SEC, are net buyers of Franco-Nevada. This is a low percentage. A reading above 50% would signal broad institutional enthusiasm. The fact that only 3.4% are net accumulating suggests significant institutional skepticism or indifference. Looking at the most active Guru holders, First Eagle Investment Management maintains a 1.87% portfolio weight in Franco-Nevada and has recently added 26.5% to their position, signaling conviction. Thomas Gaynor at Markle Group holds 1.47% and has added 3.66% to the position. These are modest-sized bets by top-tier managers, not massive concentration plays. Insider ownership stands at 0%. Management holds virtually no stock. This is a notable red flag. When company executives and directors own minimal equity, it can suggest misalignment between their interests and those of public shareholders. Insider transactions over the trailing 3 months show 0 buys and 0 sells, indicating no signal from company insiders on valuation or confidence. In summary, institutional ownership is concentrated among a small group of quality-oriented gurus, but the broader institutional market is not rushing to accumulate. Management ownership is negligible, and insider trading activity is silent. For investors who follow smart money, Franco-Nevada sends a mixed signal. Some elite managers like it, but the crowd at large is skeptical. And finally, the verdict. Let us bring it all together. On valuation, Franco-Nevada is trading at a meaningful premium to intrinsic value based on our DCF analysis, but Wall Street analysts see approximately 31% upside to a consensus target of $303. A fair value range, in our view, sits between $273 and $305, representing approximately 12 to 31% upside from current levels. On financial strength, the company operates a fortress balance sheet with 0 leverage, exceptional liquidity, and virtually 0 bankruptcy risk. This is a major structural strength. On profitability, Franco-Nevada is exceptionally profitable on an accounting basis, with net margins above 60%, reflecting the efficiency of the streaming and royalty model. However, free cash flow lags reported earnings, warranting monitoring of capital deployment decisions. On growth, the company is a modest growth business with maturing expansion rates in the low double digits, not appropriate for investors seeking rapid top-line expansion. On smart money, several elite managers hold the stock and have recently added, but the broader institutional market shows limited enthusiasm, and management ownership is negligible. Bringing these dimensions together, Franco-Nevada is a high-quality, fortress balance sheet business with exceptional profitability and a durable competitive moat in precious metals streaming. However, the valuation is stretched, growth is maturing, and institutional sentiment is lukewarm. The stock warrants caution at current prices. unless investors have high conviction that gold prices will accelerate meaningfully, or that new streaming deals will drive significant value creation. Everything in this video is our interpretation of publicly available data and not financial advice. Please consult a licensed financial advisor before making any investment decisions. That is the deep dive on Franco-Nevada Corp. Like and subscribe so we can keep providing you with no-nonsense, data-driven analysis of stocks. We will keep updating our videos as soon as new data that affects the stock becomes available.